Hey, greetings, traders. Samantha LaDuc, founder of LaDucTrading, and Craig Shapiro, our MacroAdvisor EDGE manager. Very glad that you could join us on this Wednesday, the 26th of April, so we can talk macro to micro. This is our power hour, and we do this publicly every 2 weeks. Every week we're conversing with clients. We do this for clients, but we make it open so that beginner, intermediate, advanced can just kind of pop in and ask us questions related to the market. We actually have 3 products at LaDucTrading, so that's why I say beginning, intermediate, advanced. So whether you are a newbie starting out, we have a product that is very much focused toward mentoring and guiding clients safely with their positioning. And then they graduate up to the intermediate level, which is where I run my club, my fishing club, and very much macro to micro, including a live trading room, as well as lots of other analysts on the trading desk that we populate all of our analysis and trade setups in a client Slack workspace. And those who are definitely managing money, their own or others, we have a pro-to-pro offering called EDGE, and that's where Craig comes in and offers a concierge service of not only interpreting macro event risk, but also portfolio positioning. So welcome, very much grateful for your time. And I'm going to turn it over to Craig to kind of give us an overview of these choppy markets. Risks definitely are rising, and I'll let you then pop in and ask some questions after we get going, group. But for right now, Craig, what's your assessment? What's happening, and how much further do we have to go?
No, sounds good. I mean, coming into the week, my thought was that this was actually going to be a fairly light macro week and much more of a micro week with earnings. 40% of the S&P reporting, a bunch of the big tech names reporting, and so figured macro would take a bit of a back seat, and that's been incorrect. Obviously the idiosyncratic single stock earnings stuff has been front and center with Google and Microsoft last night, and Meta's about to report soon, and Amazon tomorrow. But really, I think what we're seeing in markets is 2 other large macro factors which kind of lead into the Fed meeting for next week. And one has to do with the debt ceiling, which we've been talking about here and in the channel and on Twitter and everywhere else. And to what extent does lower than expected tax receipts, which have come in, mean that there's a possibility that Treasury will run out of cash in early June versus in later on this summer? So there's some discussion about that. And now that Republicans have brought forth a bill, theoretically supposed to vote on that bill this evening, we could talk about the dynamics there and the likelihood of that being passed, or what that actually means for the timeline. And the second thing has to do with First Reserve or FRC, the bank, and whether or not it's going to survive. I think kind of coming into the week, folks, maybe didn't have it on the radar screen as much. Figured that them being able to access the deposit window and the new Fed BTFP facility meant that they were fine. They reported numbers after the close on Monday, and have since the stock's down, I don't know, 60, 80 something percent at this point. So as there's fear now that they're going to be forced to sell, up to $100 billion of assets, whether or not they're going to be able to continue to access the discount window as their kind of internal FDIC rating might be cut, and whether or not any banks are going to come to their rescue to buy the equity or have them just go into receivership. So that's that's starting to become kind of top of mind, front and center here. And then both of those things lead into the Fed meeting next week. And so as far as data is concerned, we do get more data the tail end of this week, some GDP stuff, and then the PCE on Friday. But there's still a call it 75+% chance of the Fed hiking rates by 25 basis points next Wednesday. Doesn't seem like, unless we have a particularly, fearful market crash in the next few days, it seems like that's going to happen. But beyond that, it'll be interesting to see how the Fed thinks about pausing or continuing its tightening agenda amidst kind of this growing credit strain, yet another bank that's come under pressure and maybe forced into receivership. And, what does that mean for their inflation fight? So a lot going on right now. Again, micro is taking the day by day, plenty of companies still to report this week, but as we transition into next week, it's going to be macro time, in addition to the Apple earnings, which obviously at 7% of the S&P is a big deal. So lots to discuss, lots to think about. And we'll let's kick it off.
And the other two important macro event risks, non-farm payroll next Friday, the 5th, and Bank of Japan has a meeting with an announcement, or at least published results of their study. I think it's Thursday night, so we'll get that Friday morning. And that's actually one thing that Alexander is asking, an assessment of what happens, gold bonds with Bank of Japan. Are there any changes expected for this Friday? No, but they also just put out, kind of the whisperer article again, where they could make a surprise decision at any point, and they literally used that expression. So there's really a hesitation, I would say, for positioning ahead of BoJ because of that tease. Any thoughts in regards to Bank of Japan? And then I will comment in regards to like my thinking on bonds and gold. But first, Bank of Japan.
Yeah, I think, there's not much, I don't think, priced into a surprise at this meeting. I think if you believe that central bankers talk to each other and that there's, particularly amongst the allied central banks, amidst the banking issues that we're seeing in the US and the debt ceiling, and whether or not Japan is as the largest foreign holder of treasuries, whether or not they're going to begin a tightening campaign that may lead to treasury selling. If you believe that banks talk to each other, my sense is, given the heightened risk that we're seeing right now in the US, Japan's likely to just kind of stay on hold, not really signal much here. So I don't really anticipate them doing much at this point. I think they would wait for maybe a calmer situation in the US before they were to announce something more drastic on tightening. But ultimately, I mean, if you look at the FX hedged yields of Japanese investors investing in US treasuries, they're massively negative versus kind of keeping the money at home, with the prospect of yields likely going up over the course of the next 6 to 12 months. I mean, there is going to be a repatriation story where money is flowing back into Japan, which I think will be yen bullish, and opens up some risk for the U.S. Treasury as it thinks about selling trillions of securities once this debt ceiling is behind us. So again, I don't think it's necessarily something for this week, but it is in the back of the mind.
Any positioning? One suggestion was long the 30-year Treasury bond in case Bank of Japan does kind of decide to roll their policy, or otherwise wreck markets on a surprise policy announcement. Any particular positioning that would kind of take advantage of that?
Yeah, I don't think long duration would be the way to play that. I think if they're moving rates, rates are going to move at the long end. And so if we get higher yields at the long end, that's going to drive up yields everywhere. Now, it's likely to cause a market correction and risk off situation, which I guess would be the kind of the thought process behind buying duration. But I think we would have kind of a step function kind of reset of long-term yields higher. So no, I don't think I would be desirous of buying the 30-year in that case. I think you'd be better off kind of sticking in fixed income in the front end, where you can still earn 4.5-5% pretty much risk free at this point. So
that's a really crowded trade, especially on the 1 to 3 month time frame. When does that peter out and roll over? I already see signs of it, but in regards to avoiding the debt ceiling and potentially this crowding out also for risk aversion on any Bank of Japan decision, at what point does it's kind of like done?
Yeah, I mean, it's crowded, but it's not, it's, you still will get your money back. It's still, you don't lose your money. So, I mean, I don't really, there's not too much in the way of risk. I think the front end is being, is complicated because of the debt ceiling dynamics in play. So what we're seeing now is yields on the shortest of short maturities moving lower because there's no risk of default by Treasury, let's say over the next 4 to 5 weeks. That's how most people are viewing it. Then as we move into June, yields are on T-bills for those maturities have been moving higher because there is a, some would say 15 to 30% chance of default risk in that window. Then yields move down again, kind of June 15th through call it July 15th, because there are tax payments that come due that'll help restock the TGA. There's also emergency measures that can be added to at the end of June. So that's what, so it's a weird T-bill curve. And then beyond that, starting in the middle of July and beyond, that's where there's more likelihood of this default scenario playing out. So I don't think we're going to be out of the woods, very quickly here on this default ceiling stuff. I think, it seems like Republicans are going to pass this budget today. I think that, this bill is, goes nowhere in the Senate and goes nowhere for the administration, but it, I think, grounds Republicans into a fight, into saying we are only going to pass something on the debt ceiling if we could pass something on the budget. And Biden has said he's only going to pass a clean debt ceiling bill, and we could talk about the budget later. So it's not exactly clear to me how this will get rectified expeditiously without the markets kind of forcing both one or the other side to come to the table. Now, I think what we're waiting for an update from Treasury about when the new X date is going to be. I think Treasury is withholding that information right now because they want to see how this vote goes. But I suspect that either by the end of this week or certainly by the middle of next week, when they have their TBAC meeting, we will have a better idea of whether or not Treasury itself believes that there is default risk in the early part of June. And I think if they were to admit that, I think the markets would be, I think that would be a surprise to many. And I think the markets would react violently, because of that. I think if Treasury comes out and says, yes, we're going to make it through June, there'll be some relief that this is not something that anyone has to deal with and then imminently, and that we could wait, to the summer, and then we'll deal with the nonsense, in the summer, and then we'll have to deal with the 11th hour stuff and the back and forth. But that'll be, closer to when the White House would have to negotiate on a budget anyway. So I think that's, it's TBD. I think we'll learn in the next few days whether or not this is a June battle or more of an August battle.
And it's typically been pushed out to August, then they all go on vacation, then it becomes a September, October, the markets crash. So the typical seasonality, if you will, of a dip in this time frame, and then it kind of chops through summer, and then we get more weakness into the fall. Sandeep is asking, speaking of Japan, Warren Buffett's visit there, what are some ways that, we're not able to do what he has done, investing in 5 trading companies. But as it relates to assets in Japan and following some of that bullish bent of money flowing into Asia, I worry a little bit that this is a little bit of last money in, first out. But I guess this is, a question for more longer term trend investing. What would you recommend in that regard?
Yeah, look, I mean, I think that Japan, that there's a re-industrialization, remilitarization story in Japan, developing over the next several years. If you think about a world where Japan starts to move away from the US in any capacity, or needs to kind of, build up its armament, to fight against a potential risk in China. There is a story for domestic inflation in Japan. There's a story for reindustrialization. There's a story about normalization of the yield curve in Japan. And so I think an environment, and Japan has a massively positive net investment position abroad. So it could very easily bring back repatriate a lot of that capital, which again, I think would be yen bullish, probably modestly, fixed income bearish in Japan, but probably, for all else equal, probably equity bullish. And I don't get the sense that there's structurally overweights in Japan, versus where people have had exposure in Japan, historically 5, 10, 15, 20 years ago. So there's definitely money that could, flow into Japan. So something like the EWJ, which is, the Japanese ETF that's, that you pick up the yen strength, I think, is kind of a backdoor way to play that, on a medium term basis, as opposed to, some of the individual equities, which I don't really know too well.
Okay. And on the related question, as it relates to at least my continued mantra of the dollar yen USDJPY, very much trades inversely with obviously yen, but gold and bonds, less so bonds, but nonetheless, the precious metals trade has come under some distribution in the past few weeks since this whole announcement of Buffett, traveling to Japan and disclosing his increased stakes in those 5 mega trading houses, all of which deal with commodities. So that's one way, is eventually, I think, it's still the mantra of things over paper, whether here or abroad, US or, Asian related commodity stocks or ETFs is going to be a very solid way to play it. But in any case, his announcement definitely caused this this stickiness to the dollar yen kind of pushing up a little bit, yen softening with precious metals. It was all very conveniently timed, whether or not correlated. But my point is, I still see distribution, Alexander, in bonds, even though we're still waiting for ZB and TLT triggers long. It's absolutely just not triggering until the 10-year can fall and stay below 3.33. And that would be a deflation impulse. And right now we're just chopping in between this, 3.3 and 3.8. It's a little frustrating, but bonds are going really sideways. And there's a risk premium that is kind of built in on the longer end, but not so much. In other words, are we going to have recession, default, all these other things that are kind of giving a little bit of support, but I don't see anything right now but distribution in precious metals and in bonds. So I'm looking for that kind of break out of the box, either higher or lower. So I still think we have risk of the dollar yen moving higher. If you kind of look at a chart of the dollar yuan, you see it scooping up and pushing higher. And typically these two carry trades trade together. So the fact that the dollar yen hasn't pushed higher yet, to me, is just, it's threatening that it will. So not that it's going to be a big drama, but I am absolutely expecting it to push above 135, get into 137 again. 138 happens to be the 200-day. If we were to get above that, I think it would hit its head on 140. So that inverse with gold and silver and miners pulling back is basically that trading range. So for right now, I think it is sideways. It is trend bullish, but I think right now we've got risk of it pulling back more, gold and silver. Okay. What are you seeing for right to the jugular, 3,500 or 4,500 SPX? If you ask any questions in regards to price targets, give a time frame. Because like I had mentioned before, we actually have 3 products, right? So the community, which is very much focused on momentum trading, they're not looking at longer term trends. My community is definitely more mix of active traders and investors, and they're interested in trends as well as, I run a daily trading room. They want to see what's moving and they want to play that on swing or chase timeframes. But more of portfolio positioning is more of what we're kind of addressing. But as it relates to SPX, I think that there's definitely some weakness coming in. I already called that last week. So Friday, I actually had told clients 40.89, overshoot to 40.73. Those hit. There's been a little continued fall into 40.50. And now I don't see any, in my intermarket analysis, any support yet. So in other words, I still see weakness coming in. And I'll let clients know when we get into a level where it's by the dip, but definitely I don't see it yet. And I do mean for a swing duration. So I'm not talking about, tomorrow morning's open. So if you want to kind of clarify your question on time frame, that would help. Okay, Craig, any comments in regards to moving into this FOMC, if you think we're going to have any relief, any bounce? I mean, I personally think it's going to be one hike and then pause, but I'm definitely like everyone else kind of reading the tea leaves differently now, because we had such a dramatic move yesterday with some continuation today in, direct opposition to the Microsoft beat that is very, very strong and still bullish. So what's your kind of feel into FOMC, since there's a lot of unknown in that particular event?
Yeah, look, I think coming into the week, the idea that the Fed was going to be raising 25 in May was pretty well in there, 90% plus odds, and there had even been some growing odds that they could go again in June. I mean, we had a fairly robust set of data points on the economy so far for the month of April, and so things seemed like they were in today, and the Fed would have to continue its tightening agenda, and we started to get some of the rate cuts that had been priced in. They started to get priced out. Now, where are we today is that we may have another banking, crisis again. And so it's, similar timing in that we're in a blackout period, a bank's about to go under, the Fed's, is going to be asked about this. And so, we're starting to price down the odds of the May hike, but it's still 75%, and we're starting to price back in cuts again. And I saw a chart today that from, I think, MacroAlf, it was saying that the amount of cuts being priced into SOFR curve right now is, I think we're close to 8 or so, is 8 cuts over the next 2 years is like record, as far as, how much easing the market is expecting versus what is being, let's say, surmised by the Fed in the dot plot. So I think there remains a disconnect between the market's expectation for easing and the Fed's bar for easing. But if another bank goes under, we could be into that financial stability risk concern again. And so what I'm watching there is to see if fixed income vol starts to elevate again. It has started to move a little bit. The move index has moved up. Today it was down, but it has kind of come off the lows. And I think the move index, and generally speaking, fixed income vol is a good way to kind of evaluate whether or not the Fed is going to be forced. I could throw the chart up if you want me to screen share it. But,
yeah, I want you to screen share, but I also have a chart I absolutely want to show. So let me just make that available. Hit it.
Yeah, let me screen share this.
Yep.
Hold on one second. So look, I think the Fed has, has a dual mandate of maximum employment and price stability, but it also has this third kind of secret mandate, for lack of a better word, which is about financial stability and proper U.S. Treasury market functioning. And I think, in order to see whether or not the Fed believes in proper U.S. market functioning, we could look at fixed income volatility as a proxy for that. And so back in late September, into the gilt crisis, you saw this move index kind of, steadily marching higher, gapping up towards this 160 level. And then lo and behold, the Fed found, and the Treasury together with the IMF and some data and the BoJ found a way to silence the volatility in the bond market and allowed for the resumption of a risk on move with dollar weak and assets largely moving higher as the Fed was able to take vol or these entities were able to kind of drastically reduce vol and remove financial stability risk. So what happened more recently is a similar move here as these banks are starting to come under pressure, SVB and Signature and the like, bond vol goes through the roof. The Fed realizes once again there's a financial stability risk, and so figures out a way with this new facility and encouraging borrowing at the discount window to remove volatility from the fixed income market. And so bond vol falls again, risk assets rise, and everything is fine once again. So where are we now? We're bouncing here off of these lows set, call it, last week. Bond vol starting to move higher. We'll have to keep an eye on it. I think if FRC suffers more in the next 48 hours, we're going to see more fixed income vol, which again likely leads to this risk off behavior and potentially forces the Fed to talk down the prospects of tightening at the meeting next week. However, if somehow First Reserve is solved and the bond vol is back down here into the time of the meeting, well, then the Fed has to think about its dual mandate again, which is maximum employment and price stability. And so if we're here, there's no financial stability risk, inflation is still a concern, it's likely that the Fed will then talk tough again about, they could still do more. They don't really see yet credit contagion becoming a big deal, and it could sound more hawkish. So I think it's path dependent how the Fed is likely to react next Wednesday. I think if vol is elevated, they'll seek to dampen vol. I think if vol is compressed, they'll look to kind of reintroduce a little bit of vol because they don't want a situation where they are perceived to be too dovish. Inflation expectations reignite, move higher, risk assets go to the moon. We've already started to see some evidence of that with these big tech earnings, with how crypto is traded. And, it's not, I don't think that's necessarily something the Fed wants to see before it has solved the inflation dilemma. So again, path dependent into Wednesday, depending on how this banking situation gets resolved in the next 5 days.
It's funny, Bitcoin bounced exactly on 27,000, which happened to be a technical level, but it bounced the same amount as Microsoft, like 1-to-1. It was very tightly correlated. I want to show something as well. Hold on, right here. All right, so this was in question to kind of like you just showed the move index. I just want to show a chart that I gave clients on Friday, the 21st. In addition to this, I have a net buying selling indicator, and it showed clear selling last Thursday. And so my bet coming into this week was 4089, 4073. And obviously we tagged that yesterday, but the chart I want to show is one of the reasons. There were lots of reasons. I had lots of reasons. Gamma, liquidity, debt ceiling, tax collections, all the stuff that you did drill into in detail. But in particular, I said, okay, this credit chart, a high yield is absolutely, is absolutely what I've been waiting for. So this happens to be high yield OAS, and I use it, again, it's kind of credit stress in a system, how we doing. This was clearly the bank crisis through the 10th and then the 12th and the weekend, and it stayed elevated for that entire first week. Then we found, Credit Suisse and First Republic both failed. So it stayed elevated, and then it started to come back down because the Fed, obviously with Treasury, said we got this. Everybody gets a car, right? So don't worry about it. We're going to backstop everything. So they created facilities to do that, and then basically credit stress eased. Market went up, it bounced, and then we broke through lots of layers of technical support. Now I know who the heck puts a pattern on a high yield OAS chart. I do. I love this thing. So anyway, here we've been waiting for this, and that's exactly what I was talking about. Now here's where we are. So let me just scroll in, right? This is when I'm like Thursday, I started to see net selling. warned on Friday, and then here we are Monday, Tuesday. We got Monday, Tuesday, excuse me. So it's starting to percolate higher again. So you've got the MOVE index showing that stress in interest rate world, and I'm showing it just in HY alone. But this is why I like this chart, because you can go all the way back down, not back down, all the way back to 2019-20, and then you can see this big COVID lockdown crash and a very kind of similar trend line. This is when the market's, digesting bullishly and all that jazz. And every time we come to, you can see the July bottom, markets went up. You can see the, September, October lows when we had all kinds of central bank intervention. But the point is, it's only here. It's, that's just a print, but it's the direction of the print that matters. So I'll be watching this pretty closely as you are with the MOVE index. So question we are getting is about gold and how, how do you feel about gold longer term? I'm, of course, cautious right now because it was such an outperformer for Q1, right? Miners outperformed silver, outperformed SPY, outperformed gold, outperformed SPY. So it was a fabulous trade. Now you were in it for macro reasons. There were technical reasons. I've got my intermarket that I can show, briefly. But now I see distribution, and I am worried about if it was a regular trend trade that's breaking all-time highs, I'd be so excited about it because I love strength. I love, instead of bottom fishing for trend trades, I love breakouts. The sector leaders and the sector rotation leadership in breakout into blue sky territory is my beautiful trend trade. But this is a macro trade as well. So it can absolutely succumb to the whims of collateral selling and all kinds of other things, dollar dependent. So first, kind of share your views on the macro trade around gold, how you come in and out of it, and do you see it as a trend trade, as a positioning trade for this year?
Yeah, so I've been pretty constructive on gold all year, and there's been a variety of, I think, structural and cyclical reasons to be involved. And really, for me, in my view, gold anticipates the eventual change in liquidity that comes from a Fed that's been too tight. And so I think ultimately the Fed will be successful in bringing inflation down, probably will need to create a hard landing and then put people out of work. And then it will realize the error of its ways and will, pump money again and weaken the dollar, and that will be bullish for gold. And gold kind of anticipates that dynamic. Now, what I think's been happening so far this year is that gold has benefited from two other factors, which really weren't necessarily part of that thesis per se. One was the debt ceiling, in that if you believe there is some risk that the U.S. government's going to default on its obligations there, and the banking system is going to become is going to go to disarray, you want to have some gold in the portfolio. And then even just more generally speaking, the second thing, just on the banking issues themselves, if you're worried about bank failures and you're worried about losing deposits, gold becomes another place where you could store your wealth and store effectively store cash. So but ultimately I think gold is also, and this is the secular part of it, gold is also increasingly becoming part of a multilateral currency system that is developing as more and more countries, particularly our enemies, are utilizing other currencies to trade commodities and to trade goods away from the US dollar. And so these various countries that will trade, oil in rupees, or will trade iron ore in RMB, or in Brazilian real, or whatever it is, increasingly are pricing and trading those commodities away from the dollar. But these countries don't necessarily want to hold currency of every country in the world. And so they would be and have been using gold as a neutral reserve asset to hold, to store that excess wealth. And so central banks have been buying gold on back of this as countries move away from holding non-dollar FX reserves. There's clearly a story with Russia and sanctions and other countries fearful of sanctions kind of transacting away from dollar. So gold is growing again in importance in a multilateral currency world. And so I think that is, going to remain fairly constructive for the gold price. And if I think about positioning, most folks still are overweight sovereign bonds and are underweight gold, as a structural, 60-40 portfolio. So from a flows perspective, if you're concerned about, just general sovereign risk in a deglobalizing world and an inflationary world, and you want to sell sovereign fixed income, gold is a likely place to put that. And if you believe that countries are going to continue to print money in order to pay bills and devalue their currencies, well, devalue against what? It's going to devalue against hard assets like gold. So
and oil,
and just commodities, generally speaking. So I think gold is it's not something that I think you want to have the entirety of your portfolio but I think there's a case to be made for structurally higher gold prices, over the next 3 to 12 months for sure.
Yeah, I agree. The portfolio allocations to gold miners are definitely under allocated. So, and positioning, flows, sentiment, all of that have turned bullish. And I'm not a gold bug or a silverite. I follow money flow. It's a really big tell for me. And then my kind of wonky intermarket analysis, which has also, triggered some trend long signals in gold back in December, and they hadn't triggered for a few years actually. So I'm watching that, but it doesn't mean that folks can just stay complacent. I mean, unless you're a hodler of gold, but I mean, it still will have the ebbs and flows, and a swing short pullback was a recent recommendation. Even though trend long, it still looks great. Recession risk. How is your kind of take if we get more of that data pulled forward? Will gold be a proxy for recession risk?
Yeah, I think gold is really the proxy for the reaction function to a recession. So
and looser monetary easing.
Yeah, so if we get that recession that brings down inflation and that puts 1 to 2 percentage points of Americans out of work, then it's more likely that the Fed will react to that through cutting rates and re-engaging in quantitative easing. And so both of those will effectively weaken the dollar, and we'll be bullish for gold. I think that there is a risk that, broadly speaking, Treasury has to issue so much debt once the debt ceiling is lifted to restock the coffers of the TGA, to kind of deal with a growing deficit, with tax receipts being weak already. If we go into a recession, tax receipts are likely to fall even further. So there's going to be an even larger need for Treasury to issue paper. If you believe that Treasury can't really live in a world where its rates are 5 or 6%, then the Fed comes in, cuts rates, there's yield curve control or something along those lines. That's going to be very bearish for the dollar and very bullish for gold. So I think that's kind of all in the cake. Coming later this year.
And I'm just going to show some wonky intermarket. I'm going to fly through them just because, but I agree. From just one overarching reason, if you're looking for proof that gold can be a productive crisis hedge, also, then there isn't really a better play. So let me just kind of show this. And these are some wonky little charts I share with clients. I'm going to go through them real quick. You got that screen? Yeah. Okay. So this is bullish percent index for miners. Recommended basically when central bank intervention came in, it was extremely oversold. This index basically can't get over 100 or below 0. Last time it was 0 was, I think, May of 2016. We had a very strong impulse higher in gold. Anyway, this already had triggered and it pulled back and it was doing really, really well. But basically, it has continued to perform very, very well. I have another indicator that's basically a ratio, and gold literally took off in the same kind of time frame in 2018, confirmed December 2018, and had a really this is the indicator, but had a really nice trending correlation with gold. So it's starting to trend was basically my recommendation to clients. Obviously, its relationship inverse to the dollar. We got that central bank intervention in September, October of size, ended up being over $1 trillion, according to Matt King of Citibank. Anyway, that helped set off gold. And this has continued. I still see the dollar pulling back down to 98. So I do see this impulse still strong in gold. I just think we have a short-term digestion period. This is wonky, but it's basically inverse to dollar yen. And this is another indicator that I use for gold. Again, basically triggered back in 2016, again in 2019. And when this puppy gets above my cherry-picked indicator, it tends to trend extremely well. And it did it again, basically in December, January. I wanted it to come back and confirm, and it did confirm. So I definitely have the macro agreement with you, but I am definitely one who is watching the dollar yen as it relates to short-term gyrations in gold. And that's all there's to say about that. So what other questions would you like to ask? I think, one question was about earnings. What's your take on earnings, Craig? It says, we have been hearing that both top line and margins should be squeezed because of higher Fed rate, but has it really materialized? And do you think it will make one more quarter for that to show up, or it's just going to whistle past it? What's your take on current, aggregate earnings?
Look, I think earnings have largely, I'd say, held up better than expected, although still showing a trend of deceleration and declines year over year. So I think we've seen a lot of companies that have beat, revised lower guidance. The bar has been set pretty low, and so there's been, a fair bit of positive surprise versus expectation in these reports, which is good for for companies and for stocks. But as far as outlooks are concerned, I think we're seeing this idea about margin squeeze and top line deceleration is evincing itself. It's just maybe it's taking a little bit longer than I think folks probably originally would have thought. And that's because, look, the data has been better than people would have surmised. And when you have still sticky inflation, you have high nominal GDP, it's just hard to break. It's hard to break that top line. And companies have done an okay job kind of managing costs. But look, I think, the lag with which these rate hikes kind of filter through the economy, I think is a debatable item. First, it hits housing and more, economically sensitive and rate sensitive parts of the economy. And then as unemployment starts to move higher, it filters through more parts of the economy. So I think, finally, we're starting to see claims move higher, continuing claims move higher. I know they haven't triggered, I think, a threshold that you're looking at, but, they're starting to move higher for, months and months at a time now. As that continues, there'll be more layoffs. There'll be, tougher retail sales comps and tougher earnings momentum. So I don't think we're going to see this hockey stick like reacceleration of earnings in the second half of this year. I think amidst a Fed tightening regime that's likely to stay at terminal for a long period of time, there will continue to be pressure on earnings growth. And, I think we're just kind of getting into the start of it.
I just want to this is from the 24th, but still markets definitely were, much higher off the October lows, but there's still no sign of the earnings bottom. And I think this is, and this, by the way, is small, medium, and mega cap. So there's still no bottom. I would agree, based even on this particular chart that I've shown before, in not only to clients, so track this very often, but it's a trend trading time frame. So kind of keep that in perspective, but it's gap SPX. This is obviously the COVID low, and this goes all the way back to the 1990s, right? So this is a cherry picked indicator. Again, this is SPX underneath. When we're obviously that's 2008 and 2009 bottom, and then tons of QE, et cetera. So this is COVID, tons of QE, et cetera. So we have definitely been coming down. I don't think earnings recession trough is going to be Q1. Definitely need to look into Q2. But this is, in a nutshell, why I don't think this is done. And even if the consumer plays have shown, consumer staples and such have shown that they have been able to maintain top line revenue, it's obviously at the expense of increasing prices. And so far they're getting it. But that's my best chart for saying it's not done yet. I just really think we got another quarter to go. And then when that happens, this red line here is pretty important, right? Are we going to bounce or are we going to trounce? So for me, it's still going down.
Yep.
All right. Got another question. Residential real estate. I'm not Logan. Logan is someone on Twitter I have recommended highly as it relates to residential real estate. He is definitely the most balanced view. He has the most balanced view and solid analysis. I mean, solid analysis as it relates to housing. I have been very excited, if you will, about the inflationary impact on housing prices because they're going to stay sticky. I don't think inflation is going to go down back to, lower levels. I think it's going to stay at a higher plateau. So as long as we don't get a hard landing and recession and tons of job losses, which of course is still, baseline bet into Q3 that we are going to have more job losses and risk of recession being pulled forward. But as it relates to this, this things over paper mantra that I have, inflation has helped the housing, and I think it will, of course, settle as far as high prices. But I don't think it's going to crash. I have never been in that camp the past few years, even during COVID. So there's still tons of money in the system, and it's still going into hard assets, and real estate happens to be among them, in addition to gold and commodity rich stocks. So I'm definitely not a foreclosure bro. Craig, any thoughts on real estate?
Yeah, look, I think, as we see claims and continuing claims move higher, we will start to get demand for housing falling, and we'll start to get potentially, supply of housing rising as folks are, forced to transact, and the clearing prices will probably be, something that's reasonably lower than where we've been transacting for, the last several months. I think mortgage rates moving higher have not had the negative impact as folks probably would have thought, because most people have a great mortgage. If you've had a mortgage set in any time in the last, 5+ years, save the last 6 months, these are never before, often never before seen mortgages, and so there's really not a tremendous desire of folks to lose out on that great mortgage.
If they don't have to sell, they're not.
Right. And so, but as unemployment rises, and folks are, forced for a variety of reasons to start transacting, I think it will put some pressure on, on housing, generally speaking. And there's usually pretty good correlations between, continuing claims moving higher and home builder outperformance. And so I think to the extent that that's what we have, it'll be, a challenge for housing.
But we still need construction jobs to fall before we can have real teeth into this recession thesis. So that's one thing that I follow also very closely. One, of course, is the unemployment risk recession, pulling that forward. But construction makes up about 15% of payrolls, and they have not started to roll over yet. That's a really big deal. Yields obviously are a threat, as it relates to affordability, price of houses as well. But the inventory is picking up for spring. Sales were out this morning. I think they were 9.6% better than last month. But if you're talking about, 6 to 2 years, yeah, again, that trend of housing strength or weakness, I think will be better answered by Logan's threads. Happy to share those with you. My particular feel is that this is the best inflation asset that most retail can buy, because we're not going to be going out for most of us and going and getting gold bricks. We're not going to be going and taking possession of oil. We're not, literally, our home is our most valuable inflationary asset of things. So that's why it's such a fear, right, of it going down. But I think maybe the question is more about affordability. I'm not sure, but for right now, I don't see construction jobs either breaking back down. This is something I wanted to talk a little bit about that, and then I'll see if I can find that particular chart. Hold on. Yeah, I've got one. There it is. Nope. Yeah, maybe. Okay, hold on. No, you're gonna have to yeah, I can't find the chart exactly the one that I was looking for, but it is basically not showing signs of construction jobs hitting and rising to put risk of non-farm payrolls really spiking higher, and that's the biggest risk to housing. What thread is that article and slides? Are you talking about my Slack client workspace, or the one that I actually showed of this earnings still declining across cap spaces, Corey? Which one are you referring to? My gap SPX? That chart was posted under Samantha's Market Thoughts in Slack. The earnings still declining across cap sizes, I grabbed from 314 Research, and I actually had retweeted it. So no other slides than that. Oh, you want the SMH SPY head and shoulder pattern? Head and shoulder pattern? Yeah, this one is a big theme of mine. Where the heck is that pattern? I will get this for you. So this is still in play. If you remember from a few weeks ago when we did this, or even a month ago on Stock Charts TV, where when I do a ratio of semis to SPY, there is threatening a very large head and shoulders pattern, which there it is. I firmly believe is weakness cometh. Okay, so let me put this up. There we go. You can see this. So this is basically all the way back to 2000. This is the parabola that busted. And then you can kind of see 2009, and it picked up 2016. This is relative SMH. Sorry, you can't see the whole thing up here in one foul swoop. There it is. This is actually a monthly chart, so it's most effective to kind of check it out after the month is over. But we're really approaching that shoulder right here. So if I kind of intonate this head and shoulders, I'm going to be looking for this break, although we could have a little bounce like we did last time. It's a pattern, so it can fail drastically or it can continue. I am of the opinion it's not going to continue, but that's me. I saw a similar pattern in NASDAQ to SPX back in the November-December timeframe of 2021, which is how I came up with my NASDAQ underperformance call for 2022. So I'm now seeing semis start to roll over. They were very persistent. I should say this is the most resistant short. You've seen what NVIDIA did post earnings with 32 references to AI, and you can see the strength that has still been in cyclicals, semis of which are included, but I think it's petering out now. Any other questions or any comments also, Craig, on is it PCE? That's jobless claims tomorrow. When is PCE?
PCE is on Friday.
Okay.
So markets looking for 0.3% core, 4.6% year on year, which is basically flat to the prior months. And on the headlines, looking for a deceleration. We also get the final UMISH reading for that 1 year inflation number. That number had a big pickup in the preliminary report. So we'll be looking to see if that was confirmed by the final. I mean, given that oil prices have kind of fallen back down for the last few days, that I think that maybe there's some risk to that number maybe coming back down again. We also get Chicago PMI on Friday. The regional PMIs have been pretty terrible, for this season, this April season. So next Monday, it kicks off with the ISM, and markets looking for 46.8 versus 46.3 in March. So that's less than 50 is recessionary. We get the services PMI on Wednesday morning, same day as the Fed, same day as we get ADP Wednesday morning. It should be a busy macro week, as I mentioned earlier, next week. But look, I think what we're certainly seeing is deceleration in the economy, slowing growth, slowing inflation, although not as fast as the market would like and not as fast as people think. And so that creates an environment where the Fed has to be kind of definitionally slower to react to that fall in growth. And it wants to be sure that inflation has been slayed. It doesn't want to be in a position where it eases too early and reignites inflation fears again and raises inflation expectations. So it's more likely to go slow on the easing, which is not what the market is pricing in.
Mhm.
And so it's that dichotomy between where the Fed's reaction function is and where the market wants it to be that I think kind of creates this risk off window, that is what is needed to force the Fed to get to the market. And so, unless we get a very significant fall in the inflation data points on the core services ex housing side, which
We're not expecting.
are not really
Yeah.
expected, in the next several months. So
We've done a good job of decelerating, right? From 9.1 in June CPI down to that 5.4 or whatever. But now it's really going to chop around here and percolate higher with, oil's right back to where it was, before the print. So that might not have such a big impact. But aside from the inflation prints that are coming, can you talk a little bit to this yield curve inversion of the 2 and 10? I also have one for the 3-month and 30-year, but we gapped up on this bank crisis, right, back in March 12th. And it was a very sharp, as everyone knows, historic drop. The 2-year did in 3 days, what it normally takes 2 years to do. So basically we have a gap up in this yield curve, and it's a kind of a bull flattening, but it hasn't inverted. It's not, close to inverting. It would have to get above the 0 mark, but this is a massive reversal, right? Of -1. And now we're kind of pressing, 0.5. What's your read on what does this look like moving forward, especially in light of upcoming FOMC? Talk to us about this.
Yeah, look, I think
change.
this was yield curve inversion was a one-way trade for a long period of time, and folks from a position perspective, got over their skis. And so what we saw in March was, a complete unwind of that, a bunch of funds, blowing up, and kind of a resetting of price expectations. So, but I think ultimately the reason why this happened is because we had, our first kind of banking crisis. And so the effects of the Fed's tightening regime, are finally showing up in the banking system. And so what that means is that, we are likely to continue to get those effects of tightening showing up in other places. And that means credit contraction. That means further tightening of lending standards. That means a slowing economy. And ultimately, that's going to mean, lower interest rates, at some point. And so I think what we're likely to see here over the next, call it 6 months, is this twos, tens, and most curves steepen out as data comes in worse than expected, growth slows, expectations for Fed cuts start to get further priced into the market. But the recession that comes on back of that, creates a tax receipts hole. There's a need for more treasury issuance, and the long end, yields start to rise as there's a supply of treasuries that needs to be bought, and an increasing supply. So I ultimately would think that we're going to get to a situation where the yield curve kind of moves back to positive, over the course of the next, year or so. I mean, it's rare to see, this type of inversion last for long periods of time. And ultimately that's because we typically do get a recession and we do get a slowdown in growth, and that leads to a reaction function by the central bank. So, I'd be more in favor of, over a 6 to 12 month view, playing steepeners, even from these levels, which are, off the lows.
Now let's do the 3 month and 30 year before we close it, because this is obviously way extended, right? 150 basis points, and it's just incredibly extended, unprecedented inversion. What is this? What's your read? When does this reverse?
Yeah, I think we're, similarly, I think this is we're getting to, I don't there's no particular reason why this won't eventually look like twos, tens. I just think that, because the Fed has been more adamant that it doesn't want to raise rates yet, cut rates yet, it's just harder to get the 3 month, to move. But once it does move, it will steepen. The other thing too is one aspect of this, which I've been surprised about, has been this bid for duration. And I think part of this duration bid has been due to the dynamics around the debt ceiling, and not necessarily default, but maybe just what comes on the other side of, a aggressive Republican budget that leads to a big slowdown in growth. Maybe folks are thinking that's a reason to own duration, but I'm very concerned about U.S. balance of payments crisis developing, the next couple of years as foreign demand for treasuries starts to decline, given all the things that we've done with respect to sanction and reserves, the dynamics on Japan, which we talked about, a deglobalizing world that's using non-dollars to trade commodities, leads to less foreign demand for treasuries. So I think ultimately, the long end yields are going to go up materially, over the course of the next 6 to 24 months. And so I think it's just really a matter of time. And once this starts to move, that's indicative of a Fed that will be, cutting rates imminently. So that's why I think it hasn't moved yet.
All right, I'm gonna kind of close it here since we're at the 5 o'clock power hour time frame with one more chart. And I just want to, this is kind of bonus chart for anyone attending. So clients have this, obviously, Craig is, into the plumbing and the event risk that comes up with any print, whether it be GDP, PCE, we got the Bank of Japan, it's all coming this week. I'm typically pulling out and looking technically and at the intermarket, and then looking for the narrative of macro and fundamental, and a little bit of sentiment, but also quant that would actually cause a trigger. And so basically I'm working backwards from the goal, right? From the story, I'm looking for the story that will match my chart. But here is a chart of NASDAQ composite on a weekly time frame. I showed you that credit spread earlier, right? Close up, how it's kind of gotten up on that bank event, bank risk, bank crisis and bailout, and then it's softening and starting to move up a little bit more. Obviously, I'm not expecting COVID lockdown type of crash, but I am very much fascinated with this digestion again in the box of NASDAQ. Has not broken out higher or lower, but credit is a canary in the coal mine. So just kind of keep that in mind when anyone is kind of really, really bullish or really, really bearish. We don't have any follow through yet. My baseline bet is bearish. But we obviously have lots of triggers coming up to potentially cause this de-risking. And I think we kind of highlighted the top economic data prints coming in, as well as the macro event risk and positioning. And this is what we do, long story short, with clients, right? I run a live trading room. Craig is not only posting his macro analysis and all of the contributors, by the way, we've got 9 in addition to myself, in our Slack client workspace, but we're also servicing basically beginner, intermediate, and advanced clients in different communities, younger, kind of more momentum driven in our Discord community. My live trading room is very much geared toward intermediate traders who are active traders or investors, because I cover all assets, but also chase, swing, and trend timeframes. And Craig is obviously very skilled at managing the macro event risk, understanding it, positioning for it, and helping clients who manage their own net worth or manage money, and kind of communicating and operationalizing the trade with all of the backdrop of, you know, what we're doing here in the background. We make this available every 2 weeks. We're very happy to answer your questions, really good questions. If you came in late, I'm going to say, because I already see a few questions about gold and silver. We covered that in detail from a macro to a technical to an intermarket standpoint, because it's hot theme for Q1, but it's also, in my opinion, very much correlated with what the dollar yen does. And Bank of Japan has a new sheriff in town. So we need to pay attention to any policy surprises that they might be letting us know about on, guess what, a surprise basis. So, okay, I hope you got something out of it, and definitely recommend come on back in 2 weeks. We'll do another macro to micro power hour. Craig, any final thoughts before we close?
No, I think we've kind of talked about it. I felt like this week was going to be a quiet week for macro. That turned out to be incorrect. And then next week's supposed to be crazy. Maybe it'll be slow. But no, next week's going to be, you know, I think next week it'll set the tone for the rest of the quarter. You know, we'll have a sense for the banking system. We'll have a better sense about the debt ceiling. We'll have a sense for the Fed. We'll get the data on PMIs and on payrolls. We'll get the Apple earnings. And, you know, I think that will lead to a trending market for the second half of the quarter. And we'll have a better sense if that trend is going to be up or if that trend is going to be down. I'm inclined to believe that the trend's going to be down, but we'll know when we see it, I guess, and get all that data that comes through.
Yeah, we'll see it. And just like honestly, we can see it in the trading room too. We can see the selling, we can see the buying, and then we can see it absolutely going sideways. And it's a really useful timing tool. Let's just put it that way. Anyway, thank you so much for joining. I wish everyone a great rest of your evening. Cheers. Bye-bye.
Take care. Bye. Thanks.